147,840,000 Singapore dollars. That is the total weight of debt sitting on the balance sheet of a company that primarily makes its money selling $1.50 KOPI and $5 minced meat noodles. For a retail investor looking for a quiet retirement sanctuary, this number demands a closer look before we chase a 4.88% yield. My job is simple. Even if the balance sheet is not, I read the numbers that the headline skips: the interest coverage, the gearing, the free cash flow sustainability, so that the Singaporean building or living off a dividend portfolio gets the same forensic clarity that institutional money takes for granted. I've been watching this one for a while, and the number that finally made me sit up was the gross debt figure. This is one of those pieces where I had to run the data twice because I didn't believe a defensive staple name would lever up this much. Let's walk through the numbers together and see exactly what's going on behind the counter. DBS Research has initiated coverage on Kimlee with a buy rating and a target price of 52 cents. Their thesis is straightforward. Kimlee is a highly defensive play with a fortress-like position in the Singapore food and beverage sector. The analyst sees it as the clear leader in the local coffee shop space, using integrated food retail and central kitchens to squeeze out margins that independent operators simply cannot match. The institutional argument rests on three specific pillars. First, a strong balance sheet with 63.05 million Singapore dollars in net cash, which DBS believes gives management ample room for acquisitions. Second, a clear growth runway, 43 new Housing and Development Board coffee shops slated for completion by 2030. Third, a strategic pivot into the halal market through the Tender Fresh acquisition and the KOPI joint venture, targeting a $1 billion opportunity. DBS expects steady 3 to 5% earnings growth and values the stock at 18 times forward price to earnings. But this entire bull case rests on one critical, load-bearing assumption. The analyst treats Kimlee's net cash position as proof that the balance sheet is completely safe for aggressive expansion, and in doing so, completely overlooks the structural risks in that gross debt load during a period of firm local inflation. Cash can be deployed in a single afternoon on a bad acquisition. Debt stays with you until it is paid or refinanced. When we put the data through our forensic screen, the first dimension is valuation. Gearing is verified at 37.09%, with total debt at 147.84 million Singapore dollars. The current dividend yield of 4.88% clears our 4.7% minimum retirement hurdle, but the structural gate fails. Gearing at 37.09% breaches our 35% forensic ceiling. And while DBS targets 52 cents, Investing Pro's fair value model places the stock at 45 cents. That 7-cent gap is filled not by verified cash flows, but by unverified growth assumptions. The income picture adds further pressure. Net profit has compressed 7.6% over 2 years, down from 36 million Singapore dollars in 2023 to 33.26 million in 2025. Despite that, the annual dividend has held flat at 2 cents per share, which means the payout ratio is rising and the safety margin is narrowing. Kimlee's 4.88% yield sits well above the peer average of 1.7%, but its spread over the 4% Central Provident Fund special account rate is just 88 basis points. For a stock carrying this much gearing, that spread does not offer enough premium for the structural risk. Now let's stress test execution risk. A 10% increase in operating costs from rising utilities and labor shortages would compress earnings before interest and tax. But an interest coverage ratio of 7.36 times provides meaningful debt serviceability headroom. The real threat is not immediate default. It is persistent margin compression that eliminates dividend growth capacity entirely. And sitting underneath all of this is a soft flag that matters. Kimlee derives 100% of its revenue from Singapore. Any local macro shock hits this business with no geographic buffer. Insider activity data was not supplied for this audit cycle, which is a notable information gap. But the absence of an ownership signal does not change our stance. The hard gate gearing failure determines the zone assignment. If insider selling emerges, it will be treated as an additional soft flag at the next review. And this brings us to the dimension that matters most. Who is this stock actually for? For a growth investor with a long timeline, the DBS thesis has coherent internal logic. The industry consolidation story is real. The halal pivot is credible. But for a retiring Singaporean managing Central Provident Fund or Supplemental Retirement Scheme capital, the standard is entirely different. Your retirement funds cannot absorb a dividend cut from a poorly timed acquisition or a sustained inflation cycle. If interest rates stay higher for longer, that 147.84 million Singapore dollars in gross debt competes directly with the cash reaching your bank account. So where does all of that land on our forensic framework? Zone 4, caution. One hard gate failure on gearing. one confirmed soft flag on single market concentration. That combination tells you exactly what kind of holding this is. A monitoring position, not retirement capital. The overall financial health picture is clear. Dividend yield passes at 4.88%. Interest coverage ratio passes at 7.36 times. Net debt to EBITDA is healthy at 0.83 times. But the stock hits two hard failures, gearing at 37.09% against our 35% ceiling and 100% Singapore concentration. That hard gate failure lands Kimley squarely in Zone 4. Caution. On dividend trajectory, payouts have been verified at exactly 2 cents per share across 2023, 2024, and 2025. But with net profit sliding, this flat dividend floor is increasingly exposed. If profits do not recover through halal expansion or new housing and development board outlets, any 10% rise in operating costs without further central kitchen efficiencies will narrow the dividend safety margin to a razor-thin edge. This is the core forensic gap between the institutional view and our screen. Institutions love net cash stories. They look past the 147.84 million in gross debt because they focus on the cash sitting on the other side of the ledger. But for a retail investor, gross debt is the true measure of structural risk. If management deploys that cash poorly, you are left holding the debt wall. When you buy a coffee shop play for defensive income, you expect simplicity. Gearing above 37% introduces financial complexity that heartland investors don't expect from a business built on daily $1.50 transactions. You cannot pay for your morning coffee with net cash if the gross debt is what determines your dividend safety. If management deploys that cash poorly, you are left holding the debt wall. When you buy a coffee shop play for defensive income, you expect simplicity. Gearing above 37% introduces financial complexity that heartland investors don't expect from a business built on daily $1.50 transactions. You cannot pay for your morning coffee with net cash if the gross debt is what determines your dividend safety. Before we look at what to watch next, if this forensic breakdown is useful to you, the single most useful thing you can do for the channel is hit subscribe. It takes 2 seconds and it tells the algorithm that data-driven SGX analysis deserves to exist. If this kind of forensic breakdown is useful to you, Iggy's elite investors get this analysis the moment it's done, before the market has time to price it in. Full red zone watchlist, 0-day access for less than a KOPI and Kaya toast set a month. Link is in the description. 3 critical factors to monitor going forward. First, watch the September 2026 full year results. If gearing creeps toward 40%, dividend cut risk rises significantly. Second, track the Housing and Development Board tender win rate, because securing those 43 new outlets is the primary engine required to justify an 18 times price to earnings multiple. Third, watch Monetary Authority of Singapore core inflation trends, because elevated electricity and labor costs hit integrated food retail margins first. With the current price sitting at 41 cents, it rests close to the Investing Pro fair value of 45 cents, leaving a narrow 9% margin of safety. Combined with the hard gate gearing failure, this stock is a monitoring task, not a set and forget retirement holding. A 4.88% yield is only attractive if you do not have to stay awake at night worrying about the 147 million sitting on the balance sheet. 2 verdicts clearly separated. The institutional case from DBS calls a buy at a 52-cent target, driven by industry consolidation, a visible growth runway, and a defensive revenue base. That is a legitimate framework for a growth investor with a 12-month horizon. The forensic verdict places Kimley in Zone 4 caution on gearing failure, single market concentration, and compressing profit margin. Both views are internally coherent. They serve completely different mandates. If you are in your accumulation years, the growth story deserves consideration. If you are drawing down or near retirement, the forensic verdict tells you to wait for gearing to fall or the margin of safety to widen before committing your hard-earned capital. This content is produced for educational and informational purposes only. I am not a financial advisor. I am a retail investor who applies forensic analysis to my own portfolio and shares that process publicly. Nothing here constitutes a recommendation to buy, sell, or hold any security, and no specific target prices or personalized financial advice are offered. Stocks assessed under Iggy's forensic yield standard are benchmarked against a 4.7% minimum yield hurdle. Stocks flagged as growth watch fall below this threshold, but demonstrate clean balance sheet metrics and an identifiable growth catalyst. These carry a materially different risk profile and are not suitable as yield replacements for income-dependent investors. All data is sourced from public filings and verified sources. Where data is unverified, it is explicitly flagged. All investments carry risk, including the potential loss of principal, and past performance is not indicative of future results. If you are making investment decisions involving CPF, SRS, or personal capital, please conduct your own due diligence or consult a mass licensed financial advisor before committing funds.